Good day. So, I'll be continuing with the single index model 2 in the fifth lecture of module 10, that is asset pricing theory 1. So, in this particular lecture, I would be continuing with what we have seen in the previous slide or previous lecture, where I'll just give a brief about the definition of single index model, how it is calculated, what are the components, the benefits of single index model, limitations, applications, and what new additions we can do into the single index model. So, if you look at the definitions of single index model, you will find that first thing is that it is a financial model and it is simple in nature. Why it is simple in nature? Because we are just trying to compare your relationship of individual asset with overall market return. So, very simple, I do not have any much factors, I am bringing down the whole thing in terms of my return on stock to in relation to the market return. So, the individual stock which I am talking about over here could be about Tata Sons, and this market return which I am talking over here could be the Sensex. So, it is very simple. So, just comparison of these two. So, if suppose this Sensex increases, how is Tata behaving, whether it is increasing or whether it is decreasing or whether it is at the same level. So, very simple, I do not have any complex mechanism put in over here. So, that is why this is considered to be the most simple model which is available for portfolio measurement. And how is the investors getting benefit out of the whole mechanism? The investors are getting benefit because they are able to understand the individual asset return, the return on the asset in which you have put in your money in comparison to the overall market movements. So, if the market movement is going up, whether my stock is coming down or going up, it all depends on only these two aspects. So, if suppose I want to diversify my portfolio, then what will I do? I would be just increasing the number of stocks on the left hand side. So, I say that I have the stocks of Tata, I have the stock of Infosys, I have the stock of say Reliance and its comparison with the market. So, I am just saying this. So, how do I diversify? One has to go up when the market goes up, one has to come down when the market goes up, another will go up when the market goes up. So, I have different sets of stocks or shares or securities which I have put into my portfolio in comparison with the market return. So, that is why investors get it, make it easy for them to understand. Now, coming to the formula, it is very simple formula which we have already discussed. It is a combination of the systematic and unsystematic risk which is prevailing in the market along with the expected return on the individual stock in which I have invested. So, I have put this as the expected return. So, I am not going into this particular formula, I will just directly explain it over here. The expected return on the asset is nothing but it is equal to the alpha of the asset. What is the alpha of asset? Alpha of asset is nothing but performance of the individual asset compared to the expected return based off market, expected return of market. I am just underlying the words which is important. Okay. So, this is the performance of whether this can go up, this can come down. If it is positive, then it is going up along with the market. If it is negative, this is coming down along with the market in comparison to the market. So, that is how alpha is measured. Then the second part of it talks about the beta factor. Beta is nothing but the sensitivity of the asset in comparison to the overall market movements. So, it means I have already discussed this in CAPM, where beta are those factors which can have an influence on the market return. So this is the factors which is having an impact on the index. Okay. So this is individual stock, this is the impact on index, and this is epsilon, or the constant is the error term. Error term is nothing but the return which is not explained by the market. So you do not know from where this has come. So some unnatural event or an unnatural activity in relation to market index. Okay. So it means to say that individual stock performance, overall market performance, plus there could be some factors which is not directly shown in the market changes. So that is what you call as the epsilon or the error term. Now going ahead, I will take up each component of the formula. The first part talks about the expected return of asset. What do you mean by expected return of asset? The expected return on asset is nothing but the anticipation of the investor, how much the investor expects, okay, from the investment which he has made. Here I have referred it to as RE, that is the expected return from the investment in a particular asset. Okay. The second, again a continuation of the previous slide, alpha. This is equal to alpha. Alpha is the excess return of assets compared to the expected return predicted by the model. Okay. So if suppose there is an excess return which your stock has given in comparison to the market, then it is reflected in alpha. So it's nothing but the performance of individual security in response to the overall market. This performance can be positive or it could be negative. If it is positive, it means to say that your asset has performed better than the market. If it is negative, it says that your stock has underperformed in comparison to the market. So this is what you mean by alpha. Now coming to beta. Beta, as we have already seen, it talks about the systematic risk, means the risk which the company doesn't have control over. So I purchased the stock of Tata. Tata has no control over these beta factors. So there could be regulatory frameworks, there could be transaction cost being put up by the government, there could be capital gain tax, etc., etc. So n number of taxes could be put up by the government, and this is reflected in the form of beta. So that's what you call as systematic risk and its impact on the asset return. So what is the impact of any change which is brought about by the system, which is not in the hands of the company? Its impact on the assets return is measured over there, and this asset return, how it is reflected in the market index, is what we are talking in terms of beta. So beta of the market return. So whatever is the other factors. So again, as we told earlier, a beta of 1, it means to say that the asset is with the market. So 1 means if market is moving up, asset is also moving up. So the second case is be greater than 1, when market is moving up, the market is moving in multiples. So I told you in the earlier graph that if suppose the market is moving by 1.1%, then the individual stock will move by say 3%. Okay. So this is something which we talk about more than 1, greater than 1. Okay. So this is highly volatile. The third condition is when the market moves up by 3%, then your individual stock is moving up by 1%. So which means your stock is less volatile in comparison to the overall market. So that is what is reflected over here, where it is told that a lesser beta is indicating less volatility. Then the third part comes is the market return. So market return is nothing but, here we are using the market index. Okay, so I have considered Nifty or Sensex as the market index. What are the factors? So we, in the earlier slide we have seen beta just before this. So impact of beta on the market return, which is reflected as RM. I've put it in the earlier graph. So RM is nothing but the market return. Okay, so that's measured, and you keep this as a benchmark of your assets performance. Okay, so whatever change in the market index, its impact on your individual stock, you keep market index as the benchmark, and then you see whether it is very high, very low, or whatever it is. Okay, and the next part of the equation talks about the epsilon over here, or the error term. So this error term, as I told you in the earlier module, or when I am discussing CAPM, I told you that risk, your expected return is a combination of systematic risk and unsystematic risk. Systematic risk are those risks which is brought about by the system. Okay, this is not in your control. Whereas unsystematic risk is the risk which is controllable. For example, the prices of the wastage of raw material is high in my organization. So if I want to reduce the cost, if I bring about efficiency in utility of raw material, automatically my cost will come down and my profitability will increase. So this is an example of the unsystematic risk which is prevailing. So that is controllable. So total risk is nothing but systematic risk plus unsystematic risk. Systematic risk we have already taken into consideration when we discussed about market return, when we discussed about the individual stock return, that is alpha, calculation of alpha. So here alpha and beta into RM. So till this point we have considered the systematic risk part, and the unsystematic risk part is explained in the epsilon or error. So this is nothing but the non-systematic risk of the asset which is not explained in market movements. The example of this is something like change in management of a company. Okay, so this is associated with an individual company, right? It has nothing to do with the overall market. So what happens? This may not be reflected in the market index, but this may be reflected in the individual company's stock. Okay. Similarly, mergers and acquisition. So individual stock may reflect it, but the market may not reflect, index may not reflect it. So such impacts can be identified by using the error terms. Okay. So these are independent to the individual asset which I have purchased. So what is the benefit of single index model? It is very simple to understand. Why it is simple to understand? Because I am comparing one-on-one. So I am just comparing the individual assets price with the overall market price. There's nothing other things which is involved over there, even though we know that there are many factors which has been included in beta, there are many factors which has been included in standard error, everything is there, but the equation becomes simple because we are not considering all those factors. We are just saying that how is my stock moving in comparison to the overall index. So that is the simplicity of this particular model, and that is the benefit of it. The second is risk measurement. Risk measurement, it is almost straightforward in terms of risk measurement, where, as I told you, if there is any change in the overall market, then it is reflected in the change in my stock. Okay, so it could be directly or inversely proportional. So if this increases, this will also increase, this market decreases, stock may increase. So both ways it can happen, and this is a reflection of the systematic risk, because the market incorporates all the systematic risk and not the unsystematic risk or the non-systematic risk or controllable risk. Okay, so that's another benefit of it. Third is portfolio management. Since we are just having two things to be compared upon, it becomes very simple, and optimum portfolios could be constructed. When I'm talking about optimum portfolio, as I told you in the earlier slide, if suppose I have A, B, C, D, and I have different combinations of A, B, C, D, I have the same amount of money, but I have invested 10% in A, 20% in B, 40% in C, 30% in D, right? So I can have this combination. If I want to change, I'll change just the percentage. The stock will remain the same in proportion to the market index. I just try to see how the market index is behaving, and accordingly I try to bring about change in the proportion of the individual stocks within my portfolio. So that is why portfolio management is easier over here. What is the limitations of single index model? The first limitation is because of its assumption. Assumption of single index model is that market is efficient. So it is not necessary that market is always efficient. There could be some time lag between information flow and its reflection in the market. So that could be one of the reason. It may not be possible that in all markets it is possible. In advanced market, might be the information flow is faster. In developing nations, it may be a bit slower in comparison to the developed nation. So that can have an impact on the overall benefit I would be getting by means of investing in the stocks. Second is the assumption of linearity. Linearity, I told you, it's straight. I'm talking in terms of if this is moving like this is also moving like this. But under real situations, you will find that the movement of stock prices cannot be linear in nature. It would be zigzag in nature, as you see over here. So probably it may not be a direct reflection of your individual stock's performance with the market index. So there could be variation from this. So that could be one of the limitation because of the assumption that it is linear. A second limitation what you have is the sensitivity to market changes. So sensitivity to market changes, here it means about the reliability of beta estimates. So why there is a problem with reliability of beta estimates is because let us assume that the government has brought about a regulatory change in telecom sector, okay, and I presume that beta has tried to imbibe those information within itself. But how can the change in telecom sector have an impact on my stock, which is dealing with, let us say, steel? Okay, so single index model, the idea is very simple, that my stock is either directly or inversely proportional to market. But the market has what type of information? The market has systematic information or beta. The systematic information is about a particular sector or particular industry, but this particular industry change may not be reflected much in the market index, or if it is reflected in the market index, it may not have any impact on my stock. That could be another drawback of a single index model, because sometimes what happens is in systematic risk, when we are talking about, it could be sector specific. When sector specific informations are flowing, it need not affect another sector stock. So that's another drawback you have. The third drawback what you have is it is a single factor dependence. So you are trying to oversimplify the market behavior, even though within the parameters whatever we have considered, where I am talking about beta, which includes all systematic risk into the picture. I am talking about epsilon, which talks about all unsystematic risk which is prevailing. But when I am talking in terms of the overall equation, it seems to be very simple, and it reflects that the movement of my stock is either directly or inversely proportional to the overall index. So that single factor dependence is another limitation of it. Sometimes it may need not reflect all those factors. Next is, where can all these single factor index be used? The single index model can be used for performance evaluation. So one of the best place where performance evaluation could be measured is the mutual fund industry. So mutual fund industry, very simple. If suppose I purchased a mutual fund, and my concern is the NAV of the mutual fund, and I am seeing how is my NAV behaving in relation to Sensex. Okay. So if suppose the Sensex is going up and my NAV is coming down, then I would evaluate that my fund manager is not performing in accordance with the requirement of the market. So that is where performance evaluation could be done. So I can evaluate various types of funds based upon single index model in a very simple manner. The next is based upon risk management. Risk management, it's very easy for us to hedge the risk. So hedging the risk, I'm just trying to minimize the amount of risk which is involved with the investment activity which I have taken. Okay. So if suppose the market is coming down, and if there are stocks which is likely to move up in small phases, then I can try to shift the shares which is giving me a negative return towards these stocks in small parts, so that I can minimize the amount of market risk which is involved over there. The next important usage of single index model is portfolio construction. As I told you, all these are part of it, where I am talking about diversifying the portfolio. So I have different sets of instruments in which I can invest, right? Some could be increasing along with increase in market, some could be decreasing along with decreasing in market. So based on that, I can diversify in order to minimize the risk which is associated with it. Now let us come to the extension of single index model. So there's always a chance for us to increase the utility of a model which we have already constructed. So the best thing is combination of various models which can be called as a multi-factor model. So I can incorporate the CAPM model, I can incorporate the single index model, and I can also integrate the Pharma French model. So if suppose I am going to integrate all these three models together, I can construct a complex model which can give me a better result than a single factor model or a CAPM model or a Pharma French model individually. So I can have combinations of various factors. Next is behavioral finance. So behavioral finance is a catching subject as on date, and you are trying to incorporate the behavioral factors into risk assessment. So say for example, let us assume that if suppose a particular gas pollution is increasing. So in terms of pollution, increase of a particular chemical, how a human behavior happens, right? I may be turned on and I may try to take a higher risk. I may become uh, at rest and I may not be interested in taking any risk. So like that, changes can happen. So behavioral factors also have an important role to play when we are talking about risk assessment. So that's another extension which can be done. And dynamic models is nothing but bringing about a new model which can adapt with the changing market conditions. So here in the single factor model, we just had two conditions, that is index and individual stock, right? So if suppose the market changes and the market says or the economy says that from now on we will not have any index, then with which are we going to compare the individual stock? So that is another important aspect. So we should have a dynamic model in the days to come, so that whatever changes happens in the market, it is incorporated over there and it is visible. Okay. And what is the future directions to these models, whatever we have constructed? The latest importance in the finance world is on ESG factors. So I think I've already discussed this in one of the module where we have talked about environmental, social and governance factors. Okay. So a lot of importance has been given by the economies throughout the world based on sustainable development goals. So based on the sustainable development goals, ESG is one of the factor which has to be incorporated, and this is also considered by investors before putting in their investment. So as on date, you have ratings based on ESG factors. So this could be also a module which would be used by lenders to give loan to companies and all these factors. So ESG, incorporating ESG is one of the important aspects which is happening on date. And there are other important things which talks about the company's ethical impact, right, and sustainability practices. So this is also being incorporated in the ratings, in the latest ratings which are coming up. So now lots of companies have incorporated both ESG as well as the ethical and sustainability practices in ratings, which has an influence on their market rating and the prices which is fluctuating in the market. Okay. So how can this be an important aspect? I can incorporate ESG in this single index model, because in the single index model we have just considered the systematic and unsystematic part of it, but we have not considered the other sustainable development goals as one of the things. So this can also have an impact on the risk and return, and it should be reflecting in the market, because we are socially responsible individual before investing. Okay. And future researches, it will also explore the ESG performance and its relation to financial returns. So one or two of the examples which is not part of ESG, but still it has an impact on financial performance, is the CSR activities and other things, even though CSR could be considered as part of the ESG activities, but still this is having a reflection in the alpha and beta calculation. So that's one of the important aspects. And how is behavioral finance going to have an impact? Because with changing times, you have psychological influences which is happening, you have cognitive biasness, and this can have an impact on the investor behavior. So if there is these things which is happening, let us assume that I'm not happy with a particular product which a company is producing. So I have a negative influence, psychological influence towards that particular company. So automatically this behavior would be reflected in the price of that particular stock, and there could be market outcome which is there. And what is its relevance? Relevance is that I can incorporate the behavioral finance principles into the SIM model so that it becomes more predictive in nature. And basically, it is important for us to incorporate the sentiments of the population and the behavior of the individual so that the model can give me a better result in terms of the return while I am calculating. And the dynamic model which I am talking about, which I talked about earlier, is adjusting to the market conditions. So if there is any changes which is happening in the market conditions which need not be part of the systematic or unsystematic risk which we have already discussed, this can have an impact on beta and have an impact on the volatility of the individual stock, but may or may not be reflected in the market index. And how is it relevant? It is relevant because we are functioning in different market environments where we say that the market is either going up or coming down, or that is either a bullish market or a bearish market. And this type of factors can help in constructing portfolio and in managing the risk at the long run. And because all these market changes is incorporated dynamically in the beta aspect. So if suppose we are able to construct a index which can automatically incorporate these dynamic changes in beta, then it would be a better measure than the existing one. So in this particular lecture, I have tried to talk about the assumptions, the formulae of a single index model, what are the implications of other factors if suppose it can be incorporated in a single index model, and how a future index could look like to be more meaningful and giving a better result in terms of a higher return for the investment with or without the comparison of market index. Thank you.